I'm going to introduce myself. My name is Marcus Rather, for those who may not be familiar with who I am. And again, welcome you to the first webinar of the 2025 calendar year. This is going to be a market moment with Marcus. I'm going to go ahead and patent that. So thank you all for being participants today. The information that you're hearing today is created and sponsored through Cetera Investment Management and our team here at Cetera. Just a quick recap of 2024. Just going to pull up my bullet points here. So 2024 recap as far as the market is concerned, for the first time since 1998. In 2024, we saw a 20% return of the S&P 500. Now, that's not the first time that we've seen a 20% return since 1998, but it's the first time that we've had two consecutive years of 20% plus returns from the S&P 500. So 2023 and 2024 both posted 20% plus gains in the market. So if you were an investor during those 2 years, I'm sure you're very excited with the growth that you've seen. But there are some points to mention here that we also did not see a correction in 2024. Now, market corrections are normal. Corrections are measured up to about a 10% plus pullback in the market. We did not see greater than a 10% pullback in the market in 2024. Now, that's the 36th year in history without a correction. So that was a rarity, in my opinion, but we saw a 20% gain, no larger than a 10% pullback in 2024. Now, where most of that growth occurred from as measured by the S&P 500, the equal weight S&P 500 was up only 11.1 compared to the total 20+% that we saw. What that means is saying that bullet point is that the S&P 500 is market cap weighted, not equal cap weighted. What you will see throughout our presentation is that there's a large concentration or a large percentage of the growth that has occurred over the S&P 500 came from some top 10 names that you either have currently in your portfolio, that you do business with, or that you're very familiar with. Now, reflecting on 2024 themes. So this isn't the first time that I've done a presentation from Cetera Investment Management and sponsoring their themes. To remind you of 2024, what their themes were starting off the year was that the Fed was going to move from foe to friend. If this is even going further back in 2022 and 2023, the Fed was posed to be more of a foe than a friend. Now in 2024, they positioned that the Fed was going to move from foe to friend to be more friendly. They also predicted more of what they called a soft landing, meaning with the Fed moving from foe to friend and cutting rates, some of the concern was with the rate at which they increased rates, that we could see or be led into a recession. But there was belief that with all the other positive signs that was measured by the economy, that we could see a soft landing, and that the Fed was able to accomplish their job of taming inflation, getting it back to their measured rate without leading or spiraling us into a recession. So that was theme number 2 for 2024. And the third theme was that volatility would surge with some uncertainty, especially entering into an election year for 2024. So those three themes did pan out. So the Fed did move from foe to friend with a few friendly rate cuts that we saw in 2024. It was proved that we were in a soft landing. If anything, there was a recent interview that was done on the Wall Street Journal. Lael Brainerd, director of the White House National Economic Council, on Friday recently reported that he believed that the U.S. economy has successfully achieved a soft landing. So we did see a decrease in inflation without incurring or experiencing a recession. But the third theme from Cetera in 2024 didn't quite pan out. We didn't see as much volatility as was expected. As I mentioned before, we saw a 20% plus gain as measured by the S&P 500 without experiencing a greater than 10% pullback, i.e. a correction. So as we look into 2025, I am going to share my screen. You should see some of the key themes pop up from Cetera. As I pull up this slide, or as I start this presentation, I do want to mention or remind you that the market and the economy are not exclusively synonymous, meaning the economy is typically backward looking as in we have to experience a recession before a recession can be declared. We typically have to absorb the data in order for us to experience certain things, while the market is oftentimes forward looking, sometimes 6 months ahead, oftentimes a full year ahead. So it's possible that you can see certain things occur in the market that you don't quite see in the economy, and I'll be able to reflect on that based on some of the slides. So as you should see, starting now, 2025 market outlook, the great moderation. That is a central theme from Cetera Investment Management, is that they see this year as being the great moderation. Three key themes with that subcategory of the great moderation is one, things are going to continue to moderate. We still believe that there could be, again, a soft landing without experiencing a harsh type of recession. The Fed is not going to be as good of a friend as what was previously expected with their stance and how they're going to continue to adjust and try to manage inflation this year. And third is diversification is rewarded. So we have two economic themes, one market type theme, if you will. So starting off with the great moderation, as we approach the 5-year anniversary, the 5-year anniversary from COVID, we're still seeing a lot of things moderate in our economy. The pandemic and its aftermath disrupted supply chain, labor markets, inflation, and economic growth, leading to significant fluctuations across those indicators. The effects have rippled through stock and bond markets, shaping economic conditions for a few years. So taking a look at one of the measures of inflation, which would be core PCE, the three different colors that you're looking at here, they're all measures of core PCE, excluding food and energy prices, but they're measured on a 1 year, a 6-month, or a 3-month % change. And if you recall from a previous experience, what I did say is one, inflation is not, it's a fluid thing. It's not something that's stagnant. Every year there is a change in price. Every month, every day, there's a change in price. So typically what is being measured is at what rate do those prices change. And as you can see, following from 2020, we saw more of that high increase change in price, reaching highs of about 7%, getting close to about 8%. But since the Federal Reserve has started taking more of a stance in increasing rates, you've seen some of the pullback, if you will, in the change in rate of inflation. Most recently, following 2024, as you can see, all of the measures, whether it's a 3-month, 6-month, or 1-year change, they have been below 3. They haven't quite reached their long-term target for core PCE, which is that 2% line that you see on the chart. But inflation has moderated, as in it hasn't ticked up or exceeded levels that have really been measured throughout 2024. So again, we see more of a moderation that's occurring with core PCE, but we also see that in terms of the labor market. One of the things that are also being tracked for economic measure for recession or expansion is the labor market. And what you can see right now is that there's a higher participation rate than what previously occurred, highlighted in those gray boxes, which are measured by recession. The most recent recession, although it was not fully declared in 2020 following COVID, you see that there was a significant drop in the labor force participation. But we've seen growth following 2020. But at the very end of that chart, when you look at comparatively 2023 to 2024, again, we're starting to see that moderate, right? It's not a steep decline. It's not a massive incline, but it's rather a moderation. Now, the previous chart was looking at labor, the labor force participation, but we're also seeing a moderation in job seekers, job openings, and unemployment. We've seen a slight uptick in unemployment ending towards 2024 with an unemployment rate reaching slightly above or at 4%. But where that leads is as measured as job openings to unemployed job seekers, it's about close to about 1-to-1 ratio, meaning there's still plenty of jobs available for those that are seeking jobs. It has moderated though. At one point you saw that there were at least 2 job openings for every unemployed person. Now those are moderating down to a level of about close to 1 job available open for those that are seeking jobs. Now, the measure of the economic expansion, U.S. real GDP, you can see quarter by quarter, we have seen growth. But as you can see, all throughout, starting from about the fourth quarter 2023 towards the third and fourth quarter 2024, you see those bars are starting to even out. That again adds to Cetera Investment Management's theme of moderation. We do believe that GDP will continue to expand, but at more moderate levels. So we may not see as robust expansion as you can see at the beginning of the chart with fourth quarter in 2021. But you can see that moderation occur from a GDP standpoint. We do expect expansion in 2025 as well. So few economists are predicting a recession. So if you're coming here to look and ask me about a crystal ball for a recession, again, can't 100% certainty say that we will not see a recession, but the likelihood that we do see some type of recession is relatively low with the outlook of GDP. Now, mid-cycle expansion, if we gauge past economic expansions, we could see that we could possibly be in the middle of an economic expansion. So since COVID or since the bottom of COVID in 2020, as far as the economy is measured, we're 54 months into an expansion. And when you look at across the board following recessions, we seem to be in the middle of the average length or duration of expansion. 2009 set a pretty historic run, the historic run of an expansion as measured by months in GDP. It was 128 months following the global recession until we saw the most recent recession in 2020. Again, we're 54 months into what we believe is the middle of an economic expansion. And then another indicator here, I know you're looking at a lot of different colors, or if you're called in, what we're showing are a lot of different measures or tracks that the NBER measures for economic expansion. Just to explain a little bit more about what this is that we're looking at, let me grab my note. The NBER is the National Bureau of Economic Research. This body or this organization is typically the one that actually declares when we are in a recession. They look at 6 different factors, some that you can see here if you're reading the fine print, things like non-farm payroll, employment, industrial production, so on and so forth. As you can see, all these different colors, most of them are positive. None of them are trending negative. So that also complements some of the moderation theme that we believe to experience in 2025 as far as measured by the economy. Now, shifting to the second theme, the Fed is not quite a good friend. Last year, they spoke about the Fed in terms of them being more friendly. If you're looking at this chart, what you're looking at is the Fed's fund target rate. And while it's not 100% certain or a certain 100% guarantee that when we see rates rise or when the Federal Reserve raises rates that it immediately leads to a recession, there has been, at least over the last 20, 24, 30 years, there has been some concern that if they are too aggressive with how they raise rates, that could curtail or lead us into a recession, which has led to Cetera Investment Management, their previous theme of a soft landing. So you can see following 2020, we saw aggressive rate hikes, most aggressive in history. And where we currently are is, again, we successfully experienced a soft landing. And we believe that they will still play slightly the role of a friend. Ending 2024, the Federal Reserve previously thought that they would expect to cut rates about 4 times. Coming into 2025, they declared that they expect about 2 rate cuts. And as I said before, the market is a leading indicator. So where we saw some volatility ending 2024 wasn't so much due to the outcome of the election, which time-wise is somewhat simultaneous, but it was more of the announcement with the Federal Reserve changing their expectation of rate cuts from 4 down to 2. So it took some time for the market to absorb that information and try to predict if the Federal Reserve will indeed cut rates twice and by how much. Again, those answers are going to be delayed to be seen, or we're going to wait to see what those responses are. But we do believe, again, that we will see some rate cuts. I'm taking the caution of about 2, take the Fed at their word. but the market will try to adjust and predict based on that. Now, there is a gap between the Fed's fund rate and core CPI. What that is, again, another measure of inflation. There are multiple measures of inflation if you haven't quite caught on. But looking at the real interest rate or the interest rate adjusted for inflation, we're at a 1.5% difference. So there's more interest gain than inflation that's taking place, which is a good thing. You can see real rates were higher than this before the dot-com bubble in the early 2000s. Growth was also higher then. So the neutral rate should be lower today as interest rate policy was restrictive in trying to stop excess of the 90s. Now, did we whip inflation? This is a producer price index. This is, again, another measure of inflation. So while we did see core PCE pull back and moderate, we did see an uptick in producer price index. So this different form or measure of inflation did start to increase, and this could be a challenge as the new governing body, or as Trump is taking office, is threatening tariffs on China, Mexico, and other countries, Canada as well. This could pose as a challenge that the Federal Reserve will have to overcome, as increase in tariffs can also lead to an uptick or increase in inflation. So this is going to somewhat challenge the Federal Reserve stance on possibly cutting rates. They may either have to cut more or pause, just depending on the movement or change in inflation. Now, closing with the third theme, diversification is rewarded. When I previously mentioned 2024 was a second consecutive year of 20+% growth in the S&P 500, where most of that growth occurred was from big names, right? Top 10 holdings. This chart is looking from, I believe, 2000 or 1999, leading to most recently 2024. If we look at the percentage, the top 10 holdings make up of the S&P 500. Remember, the S&P 500 is not an equal weight of the 500 largest companies in the United States. It's more market cap weighted. So to this point, the top 10 holdings make up greater than 35% of the S&P 500. So I believe I see that personally as a large risk for the market and for most index investors or investors altogether, as diversification may be hard if you're really concentrating a lot of your growth in large names or large sectors like technology. As we look at valuations, the forward 12-month price to earnings valuations, we are above average. And even following 2008, we see a large spread of valuations, mostly due to the concentration that's focused in the S&P 500 in those top 10 names. So these stocks are causing valuations to be stretched while the stocks have risen. The earnings that they've had as a business or as a company quite haven't kept up. Now, what do we do with that? Ways to diversify is maybe within your portfolio, maybe taking some concentration out of large cap, but diversifying in different types of stocks, different types of equities. Colors that you're looking at here, there are three different indices, if you will. One will be the S&P 500 that I've mentioned before. In the blue, you're looking at the S&P mid cap, so maybe not the large cap companies, but more mid size. And then you have the S&P small cap. Now, these aren't mom and pop shops, startup companies. For the most part, these are well-established companies, but may not be the mega trend or the mega cap names that you can commonly think of. There are opportunities based on valuations. As you can see, the large cap or S&P 500 valuations are at 27.6 valuation price to earning, but you see a lower valuation on those mid and small cap. And what's not charted here, but is also worth honorable mention, are international developed companies. So ways that you can diversify in your portfolio is just making sure that you're touching all styles of equity, not just focusing exclusively on the tech sector or big name in the S&P 500, but broadly diversifying your equities to make sure you have exposure into other areas like the mid cap, small cap, and international sector of equity. Shifting gears into bonds, right? So another way to diversify out of equity may be into fixed income. Fixed income plays many different roles within a portfolio, whether you're using fixed income for income, dividends, or maybe you're using them as a hedge or to help mitigate some risk that you face with equities. Some of the challenges that you may see with fixed income are the yields. So fortunately, we have seen yields appreciate, even though we've seen the Federal Reserve cut rates. As measured by the 10-year Treasury yield, you've seen some of the yields start to increase entering into 2024 and closing 2024 is again moderated. September 18th, when there was the most recent rate cut, yields did drop, but they started increasing after September. Another way to diversify, again, not all fixed income are made the same, no different than not all stocks are made the same. You have some bonds that may be paying a little bit more higher yield. You have some bonds that are issued by the federal government, so their credit worthiness is a bit higher, thus their yields are lower. So we're starting to see those spreads change. In high yield markets, investors are not demanding much extra yield for taking on the extra credit risk. So while it's telling us recession risk is low, it may be telling us high yield bond valuations are also stretched. So I will pause for questions because that was the last slide from the presentation. I know I threw a lot at you. So if you have any questions, feel free to jot those in or throw those in the Q&A. All right. As no questions have popped up now, I do thank you for joining this experience again, this market moment with Marcus. Prayerfully, we'll have a lot more of these to come in the future. If you do have any questions, please feel free to submit them on the Q&A through Zoom. Please expect any type of feedback or follow-up from me by email, and hopefully this will be available for posting on YouTube for replay as well. So I bid you all a good afternoon. Hope you have a wonderful Tuesday, and I look forward to the next experience. Take care.